Hello everybody, Ben Kingsley here, and I'm delighted to share with you the brand new live version of our economic and RBA update for the September announcement that we're going to see from the RBA in about 30 minutes time from now. So I'm thrilled that we're going to try this live version. So if you're joining us on YouTube or Facebook via the Property Couch, via our More platform, or if you're valued customers of Empower Wealth, welcome along. And I also want to welcome you, Evan, to this very first attempt at doing a live stream version of the RBA update.
Yeah, let's hope it's not an attempt. Let's hope we get it done absolutely right. The reason we want to do this is because we want to give you to-the-minute understanding updates. Not only that, I'm sure, like Ben and I, you are also a bit of a RBA nerd, because once we basically finish this, it'll be pretty much time for Michelle Bullock's press conference. So please go and have a look after that to also just sort of hear her thinking and see if what Ben and I sort of dive into today meets up with that. So we don't have a huge amount of time, so let's get on with it, Ben, because we've probably got about 20 minutes to do our normal stuff and then get into the really exciting bit.
Yes, that's right, Evan. So what I wanted to make sure that we cover off is we're going to definitely take a look at what's happening in the Middle East. We're going to look at the rate changes that we've seen in the global economic update. So we'll see the US, also China today, and also quickly touch on the Euro area in terms of their rate adjustments and some of the other economic news there. Then we're going to turn our attention to the live result at 2:30 to see what Governor and the board have done at their two-day meeting. And then we're going to take a deeper dive into what's happening in terms of the property market and how that's impacting inflation before we then take a look at also the unemployment data before we wrap up today. So lots to cover off. I'm really excited about this opportunity. So let's jump into it straight away. Let's start firstly by looking at what's happening over in the Middle East. And this is obviously highly concerning for the humanitarian impact that it's having there, but also just as importantly is the economic impacts that could be coming off the back of that in regards to oil and also supply chain challenges, Evan.
Yeah, so that obviously goes through the Suez Canal, what happens through the Red Sea. From a pure economics perspective, because Ben's hit on it perfectly, the humanitarian and the other side of that is certainly not what we're here to discuss. It's more, it does have an impact on inflation, and unfortunately to the upside. Oil, Ben highlighted straight away, so that means it transfers into things like transportation, it therefore filters into logistics, and we have seen in the post-COVID world just how much of an impact that can have. So that is why you have to monitor it. You have to be aware of it. If it was to become more than just a slightly regional conflict into a regional war, that's where you need to understand that this will, although it's happening on the other side of the world, impact us economically as well.
Yeah, and obviously, those supply chain issues coming through that Suez Canal is obviously going to have bottlenecks potentially, as opposed to going all around the bottom of Africa. So that potentially does have some other delayed ramification, which puts upward pressure on inflation as well. All right, let's move into the United States is where we normally would start. And so there's been a lot happening over there, Evan, hasn't there, in terms of what's been happening around their decision, most importantly, off the back of this inflation story. So let's quickly do a run through in terms of the annual inflation rate in the US slowed for the fifth consecutive month to a reading of 2.5% in August. Now, that's been the lowest reading since February of 2021, and that's down from a reading of 2.9% in July. And that was also below forecast of a 2.6% reading. Now, this better than expected read was driven by lower energy costs, lower food inflation, and lower transportation, all those input costs. So that's also good. Now, working against lowering inflation were areas of shelter costs also went up, and apparel costs went up as well. But overall, a pretty good story in terms of the inflation read out of the US.
Yeah, and they're finally therefore getting to say that they are getting structurally, not the old transitory term that they had back in 21-22, structurally back in line. There has been a lot of the board members that have been saying this, ones that matter, people like Chris Waller, who is basically the deputy governor, Mary Daly's been saying it as well, Ref Bostic, John Williams, etc. All the main players that are voting members have said, everything is now heading back to where it is. This on screen, don't forget, that is headline inflation. Over in the US, their core inflation is still at about 2.8. but that's only 0.8% away from their 2% target. And that trend shows you that they're going there. So we'll talk about it in a minute, but that's the confidence the board has finally had to break away concentrating purely on inflation as a problem of issue, because it comes to this as well with what Ben's got on screen that we need to next cover off on.
Yeah, so the unemployment story is a big one here because it has been fluctuating a lot. And so we saw the unemployment rate in the United States ease to 4.2% in August. And that's from a high that we saw, or a low that we saw in October of 2021, 4.3%. So that was aligning with market expectations. Now, the number of unemployed individuals was broadly unchanged from the previous month at 7.1 million people. Now, amongst those unemployed individuals was permanent job losses were loosely unchanged as well at 1.7 million, whilst individuals at a temporary layoff status dropped by 190,000 to a reading of 972,000. Now, additionally, the number of long-term unemployed individuals seeking employment over the 27 weeks was steady at 1.5 million, and that's making up around 21.3% of the unemployed population. And in rounding out the data on the labour force, we saw the participation rate remain unchanged at the prior month's reading of 62.7. Moving along to the next data point, this is an interesting one in terms of the non-farm payroll. So let's talk to this particular story. So what we saw is the US economy added 142,000 jobs in August. That's more than the downwardly revised 89,000 that they adjusted for in July. And that was below that forecast of 160,000. So that was a little bit of a shock. And then obviously we then saw that employment growth was in line with the average job growth in recent 12 months period. It was below that, which was around 202,000. So we're starting to see this tapering off. And that's ultimately the challenge. And we saw that the July figures were also revised lower to 25,000. And June was also revised lower at 61,000 from the original read that they provided. So there was definitely this story here that you want to talk to in terms of what was forecast and then ultimately, what has been adjusted out of those numbers.
Yeah. And so I can't remember in the last 10 years, and realistically it's the GFC that you can put this into, seeing the non-farm payrolls so far out of whack. Like it doesn't happen like what's happened this year. And that previous chart showed you just how all over the shop it was, because all this year's been about is a question of when was the Fed going to cut rates. And everybody thought it was back in March. We saw a pop up in inflation for the first quarter, and the fact that employment was going well and truly above what was seen as sort of required to as the NARUS, that's the non-inflationary rate of unemployment, that was needed to drive inflation down, and gave the Fed, particularly those that were hawkish, the confidence to say, no, we don't need to cut rates anytime soon. We're still not confident, blah, blah, blah. And then in the last month, all of that's been shaken out, and Ben showed you that in the previous chart. Now, this chart here, and you'd think, considering that they're the largest central bank on the planet, that they could get a much better position in somebody actually putting there, because this is straight lifted from their statement. So it's a bit of an ugly chart, but that very faint bluey black line that you can see, that was their previous expectations around employment. The blue boxes are now their expectations for unemployment. And it is clearly spooked them. And you could hear that in the statement. You could hear that in Jay Powell's press conference, that actually unemployment is higher than expected. The other thing Ben highlighted before, the participation rate at 62%, at the peak of their unemployment scenario, it got up to 66%. So that also needs to be put into consideration. That actually means that 4% of the working population are not just out of the employment market unemployed, they've completely actually fallen out, and we don't know what they're doing. So the unemployment rate probably, you would argue, is even higher than what it is and what the Fed is forecasting. But this is key now. This is their justification to catch it, because we spoke about this at the last update around what's referred to as the SARMS regression indicator, which is the 3-month unemployment rate average. When that has increased by 0.5 or more from the 12-month low previous, since 1950 that has always forecasted a recession in the US. So the question is, are they going to catch the ship before it hits the recession iceberg? And that's why the reaction that they had, and I'm sure you're about to bring it up, Ben, led to this.
Yeah, so here we are in terms of the story that was the surprise 50 basis points cut, as opposed to the market expectation. Well, actually, the week before the market expectation was a 25 basis point cut, but right on that last 48 hours, we did see the market move to a 50 basis points cut, and that's exactly what they got. So the Fed Reserve cut the target rate of the Fed funds jumbo 50 basis points to 4.75 to 5% at their September meeting. And this was the first reduction in borrowings since March of 2020. Now, while the decision to cut rates was anticipated, that speculation that we just talked about before of a 25-point basis cuts actually delivered into a policy decision of a 50 basis points cut. And what we heard out of Jerome Powell, the Fed chair, was he didn't necessarily want to give confidence that we're going to cut rates at this sort of 50% level and create a further amount of panic. But it was very clear that they did have some initial concentration around trying to keep full employment as part of that story, didn't they, Evan?
Yeah, they did. And I think, again, the reason I used before the term about, that they actually had a little bit of a freak out is that all their communication, even as late as Saturday week ago, was that they were going to be slow, they were going to be cautious. The board was still realistically considering that data, although it is softening, isn't that bad, and we don't need to go down the hard route. So the economic consensus leading into it was actually about 32 to 33%. So 1 in 3 economists had the 50. The rest of them all had 25. So it did catch people off that they've gone that hard. But we did know, they'd been telling us this anyway, that they still expect 1% out of the what's called the federal funds rate, the effective cash rate, by the end of the year. So they had to do a big one in one of those because there was only 3 meetings left and it started in September.
Yeah, and we know that the market's forecasting that 50 basis points by the end of Christmas. And so ultimately, with only 2 meetings to go, it's either going to be, 25 is the consensus. But if we get another 50, which he was sort of talking down, we still get to that sort of target by the end of that meeting. Because remembering, we don't have our next Fed meeting until February, which is pretty consistent sort of with obviously the RBA cycle here, that we've sort of moved to those 8 meetings a year to get in line with the Fed. Let's take a look at the dot plot, which is also quite a good sort of story that tells in terms of what their forecasters are looking at. So talk us through some of these numbers, Evan.
Yeah, at least they got this one better with regards to whoever runs their canvas scenario. So you can actually read this one. So this is June to September. So this is they don't always give you the full updates with regards to every meeting. But so from the June meeting to where we are now, they have got this in, and that shows how big a drop from their June to September meeting the board members now see the interest rate movement. So each one of those dots is a board member. That's what they represent. They each have to put in their own forecasts every single quarter. And so that's why the September meeting was also so important, because it's the first time since June we get them. We'll get the next one back in December as well. So that's good. But you can see the significant move down that is now happening from pretty much the consensus. They are telling you that, yes, as Ben just said, by the end of this year, another 0.5%. But the one to really look there is to see what happens next year and where the federal funds rate is expected to be. I'm going to quickly touch on it because I need to say it. This is people ask, what does this mean really for us here in Australia? This is good. And the reason I say it's good is that we get the inverted commas lucky country all the time, in that, don't forget, the majority of our product is imported into this country. We are an importing nation, which means that overseas inflation impacts us as well. So does our currency. So when the currency starts to rise, which the Aussie dollar has done off this, our import costs get cheaper, obviously. And so therefore, this is also something to be aware of, is that we actually will start to have natural inflation decreases because the Fed, the ECB, the BOE, the Bank of Canada, you take your pick, They're cutting when not yet, and we'll get to that. But that means that the Aussie is on the up, and it's going to make importing costs cheaper.
Yeah, which is that great news story. So we import less of that inflation, which puts downward pressure on us, and then we're always last to the party. We can see that now with that inflation cycle sort of there at least 6 months ahead of where we are in terms of bringing that inflation under control. And so that to that point, as obviously our inflation starts to come down, our cash rate will also come down. That will then reduce the dollar disparity between the currencies that we trade in. And remember, most trade, to Evan's point, is done in US dollars. So at the moment, we're buying our dollars cheaper to buy the goods out of China or Japan or wherever they're coming from. And that means that obviously our dollar buys more of the US dollar, which means that we're paying a lower price for those goods coming in. So it's a really good news story in terms of helping us in terms of that imported inflation that Evan was talking about there. Hey, Evan, we've got a quick question before we move on to China, and that's a question from one of our listeners on YouTube, and that was from Owen. And he's sort of saying, well, how would this war impact property prices in, say, Sydney as an example? Take us through, that sort of consequence of what higher inflation means, and then ultimately how that would then put downward pressure on prices. And I'm happy to join in if you want.
Yeah. So look, the war issue, and we need to sort of put it into a little bit of consideration. We've seen similar things happen when Syria had their civil war and what happened on that side. The impacts that have been going on in the Middle East with the impact on oil is pretty well historically documented. It does, as I said, the transportation costs. So the ones to really watch here are not necessarily what you'd also think. So agriculture is normally the canary. And the reason you look at agriculture, you need to remember that places like Egypt are net importers and some of the largest net importers of grains on the planet, and particularly coming out of Australia. So you look at somewhere like Ukraine. Ukraine is actually technically the food bowl of the world, and that's why the Ukrainian war is such a headache in what it does to global markets. The fact that cereal prices, grain prices are so high, it's why you've seen a big increase across the globe, not necessarily here in Australia, on basics, really staple things. So bread indicators on the World Bank tell you that that's the impact. So Egypt's the one to watch because, again, if you have issues through the Suez Canal, they control it. They are the beacon to give you that idea. What does that mean for inflation? Obviously, it pushes it up globally. We, again, inverted commas, lucky country, we are our own food bowl, right? So we are lucky with that. But our product still goes into the global market. So our wheat products, our grain products go into the global market. And that needs to be reminded. So when you have conflict there, Egypt tends to get quite tetchy. They slow down the amount of transportation through the Suez Canal. They do a lot more security checks, etc. Things get slower, stockpiling gets higher. All of that kind of stuff starts to slow down the chain. And when you slow down supply, even though demand might not technically change, it's going to push prices up. So that's that. I'm going to go.
And oil prices, mate, there's so much oil product in a lot of our goods, plastics and everything like that. So just not only the transportation costs, but all of those raw input costs to make those final goods also flows through. So it ultimately means that inflation stays higher for longer, which means the RBA keeps the cash rate higher. And then ultimately the momentum in the property market, which is what we're seeing now, is starting to slow down. So the absorption rate of new people coming into the market as we're reaching affordability thresholds doesn't come. And so that would then change sentiment. And then that sentiment shift also starts to impact buying activity and selling activity. And that's ultimately what then flows through into property prices. So I think that's a clear reminder that the longer that interest rates stay higher in a restrictive setting, it will eventually impact property prices in this country. All right, let's move on now to talk about the news coming out of China. We saw, in terms of the China story, key takeaways from the US. Fed Reserve has got obviously a joint mandate, 2% target rate, and obviously maintain that employment. We are still seeing, a further pricing that we talked about by Christmas. And then the Fed said that it will take its time to move and be updated, or informed by updated data in terms of how they get to that neutral rate setting. So that's an important story. Let's now move into, looking at the China story. And there was some big news out of China today in terms of the governor of China. He had a press conference which is very unusual, off the back of this chart that we're seeing here, which is effectively, the golden period, the 20-year period that China saw this huge economic boom and lifting all of those people out of poverty and increasing the living standards across the country. Is, this compounding nature gets harder and harder and harder to replicate. And so we're seeing that trend line, that medium to longer term trend line, trending down. Now, what we saw out of the governor of China was basically this story of we're chasing a 5% growth story, so a little bit better than it's currently sitting at the moment. And as part of that, we're going to have to continue to keep injecting, more and more investment into this particular market. So we can see here, inflation is benign. So there's no real issue that we've got in terms of having inflationary troubles in this particular market. So what we then move to is this story of adjusting the cash rate and interest rates there. So we did see, in response, was what the Chinese governor Pan Gongshen, he basically said that we weren't expecting a 50 basis points move. So effectively, we're going to also, our reserve requirements are going to be lowered by 50 basis points. And in his meeting, he said that this will unleash around 1 trillion yuan, which is about 142 billion US dollars in liquidity. They will further adjust or cut the RRR rate by another 25 to 50 basis points at an appropriate time. And so that's effectively the rates, the refinancing rates, which basically households will pay. So that's ultimately going to free up a little bit more extra surplus or disposable income for the Chinese consumer. That will ultimately flow into the market as well. And their 7-day reserve repurchase rate will be lowered by 1.5% from 1.7%. So really geared to obviously get that consumer moving inside the Chinese market, with effectively slowing international exports coming out of China, Evan.
Yeah, and it's the one for me is the repurchasing rate. You are seeing what happens to a developing world that moves into the developed world. So you need to see the RRR back, 2010-11 was sitting at 20%. It's now down, it's halved in that period of time. So that again shows you government release, government control is being released, but it also shows that really fast, economic development that happens in a developing economy has gone. We need to say that the structural change there is gone. That's what that's telling someone like me, is that the days where they had to rein banks in for over-lending has now starting to structurally change. The requirements that banks have to have structurally changing. The corporate borrowing today was also fascinating. That's something we haven't seen really in the Xi Jinping's financial cleanup era, because he did very clearly make a very strong statement 2018 and in 2019 that he wanted to repurpose, I think is the way to say it, the overall takeaways of what's going on in China. The thing that China was happening was that it was maturing, it became structurally different, then COVID hit. And unlike every other country that had this sort of 21, 22 renaissance of release, China never got that. And this is probably more not necessarily the COVID problem. This is a change in the structure of the Chinese overall economy. So this is the fact that property market is underperforming, consumer is underperforming, that middle part of China that everybody sort of says will rescue them. Yeah, they're experiencing what every other middle class economy experiences, which is that things are slow. They've got higher interest rates. There's not as much growth that they've experienced in their lives. So they're saving more. And that's also what came in the data. And what you heard from Governor Pang today was that they have to go back to the old ways of trying to stimulate. So it was good for iron ore. For those of you that didn't see, it jumped up 3.9% this morning in Singapore. The Aussie dollar jumped up as well. It's now at the highest it's been in 6 months. So China is a new story for us and something to watch.
Yeah, well, I mean, it just reminds us that, that recency bias that we have around things are great. For 20 years, they've been pretty amazing. Property values continue to keep growing. The wealth effect was working in a positive sense of consumer spending. Now it's not working that way. It's actually the sentiment, and that wealth effect is working in the negative, where people are a little bit more cautious with their money. So the government's continually trying to stimulate to get their domestic economy moving. All right, conscious of the time, let's now quickly look at the Eurozone. We're going to quickly touch on this because, even though, we reported in our last update that the Eurozone had dropped the cash rate, we're now at a stage where you can see a second movement in the cash rate where they've eased, to 2.2% in August, and this is the lowest since July of 2021. That's the inflation story, which has led to, that came down from 2.6%. Now that's led the ECB to cut their deposit facility rate by 25 basis points to 3.5%. And this is also a move their main refinancing operation interest rate, which is the one we see on the screen here. We've lowered that to a reading of 3.65. So really, we're seeing, again, the Eurozone being ahead in terms of that inflation, sort of starting to taper off, and that's allowing the ECB to adjust the cash rate. But look, one of the things that could potentially be a risk on the downside is the domestic inflationary story around higher wages. They're definitely seeing higher wages come through in their particular market. But we have seen a moderating of labour costs and also, sort of firms' profits lowering. So they seem to be adjusting for that to try and keep that inflationary story in check. But you can see there in terms of the Eurozone, the overall summary there is quite simple, that, it's moving in the right direction. As inflation eases, we'll start to see some more improvements in terms of business confidence and consumer confidence. So we'll monitor that in the lead up to Christmas. Now, in terms of obviously their winter, let's hope they have a moderate or mild winter so we can see more of that economic activity, because that can also be quite challenging if we see a severe winter in that particular market. Yeah. So that sort of wraps up our global story. Now we want to basically do a little bit of a preview. We've got effectively about 3.5 minutes where we can talk to the RBA's story today. And what I wanted to do is I wanted to sort of just talk to you, Evan, about making a case for what might see interest rates rise versus making a case for what might see the cash rate staying on hold. So what would be a trigger potentially that would see a surprise rate rise in a couple of minutes' time?
So the surprise would be the hike in itself, but it's around, again, if you look at the monthly core inflation data, it's back above 4 and holding at 4. It's really, the term they love to use is sticky. Yeah. They have been saying for months and months that, they won't hesitate if they can't see any form of structural change in the inflation rate. And that's where the surprise is not really one, is that they have been warning and has been constantly warning, whether it's Senate committee updates, whether it's be public forums, what have you. They are still telling us very clearly that inflation is not only sticky, but it is eroding people's overall purchasing power. This is the boffin talk that they love. They keep talking about it, is that having a higher increase in interest rates is actually less painful than sustained long-term inflation that ends up smashing people's purchasing power. And so the case is there because, yes, there'll be indicators like growth, slight movements and unemployment that could hold it off. Overall, their target is still the inflation. So that's the upside. The other thing, look, the hold call, I can't see them cutting today. I just cannot say that. But your question around the hold, that comes down to growth. It comes down to unemployment. It is easing on a growth basis. And we'll talk about this after we see the statement, after we see the release, because I want to dive into that as well, which is that those two are moderating. So although inflation, it's coming down, not at a level they want, it's flatlined for the last 6 months, they would probably suggest that their slow and cautious approach on the way up is working, but it also means a slow and cautious decline in inflation and therefore higher for longer stuff. So that's why we are where we are. Again, I'm not even going to make the case today for a cut. Michelle Bullock has made it very clear that there isn't data enough for it to actually suggest that that's the case today. 2025, you and I are going to be talking about a completely different story, and I know that, Ben, and we'll come to that also after it because we're 60 seconds away. In fact, we're 45 seconds away from the drop. But it's not going to be a cut today. The cuts will come, but that will be a 2025 story. The discussion today will be how much are they still on the inflation story, and that's what we're about to find out in about 30 seconds.
Yeah, well, I think you're right. I mean, I can't make a case for a higher increase today. they would be privy to the inflation data that's due to drop tomorrow. They would have had access to that, and obviously the markets will get access to that tomorrow. So ultimately, unless there's an enormous shock in there, and then we've got to think about the fact that we've got the electricity.
I'm just going to interrupt you, Ben, because that is 2:30. So we are now live, and we will refresh.
Let's see if we've got the result. I'm at 2:30. So here we go. Let's see if we can get the statement. There we go. So cash rate on hold. So we can now have a look at that monetary policy decision and statement. So here we go. In terms of what's happening at today's meeting, the board decided to leave the cash rate target unchanged at 4.35%, and the interest rate paid on exchange settlement balances unchanged at 4.25%. Inflation remains above target and is improving persistent. Inflation has fallen substantially since the peak of 2022 as higher interest rates have been working to bring aggregate demand and supply closer towards balance. But inflation is still some way above the midpoint of the 2 to 3% target range. In underlying terms, as represented by the trim mean, inflation was 3.9% over the year to June quarter, broadly as forecasted in the May Statement of Monetary Policy. Headline inflation declined in July as measured by the monthly CPI indicated. Headline inflation is expected to fall further temporarily as a result of the federal and state costs of living relief. However, our current forecasts do not see inflation returning substantially to target until 2026. In year-end terms, underlying inflation has been above the midpoint of the target for 11 consecutive quarters and has fallen very little over the past year. Talk to the statement for me, Evan, whilst I
bring up the comparison. So for me, it's the last bit. While headline inflation will decline for a time, underlying inflation is more indicative of inflation momentum, and it remains too high. That's not just high, too high. The most recent projections in the August S&P, so it's the Statement of Monetary Policy, show that we will be sometime yet before inflation is sustainably in the target range. Data since then have reinforced the need to remain vigilant to upside risk. So the hike bias is still there. It is still well and truly inside it. And the board is not ruling anything in or out. Now, she said that last time in the press conference, and we're going to see this after Ben and I finish up. When she was asked that question, not ruling anything out, when she was pushed on that, they had ruled out cuts. There was no discussion by the board of a cut. So I don't like that line, but that line is the same as it was from 6 weeks ago and 6 weeks before that. And it needs to be made very clear that the RBA is telling you there will be no rate cuts this year. That is a given, despite what a lot of people are trying to tell you. They are also saying very clearly that don't expect them any time soon. And that means that February is probably also now out of the way, because the end of 2024 is not that far. We are about to go 3 months to the end of the year, get ready for Christmas. But it's also February is only 5 months off. But that last line for me, that second to last paragraph, Ben, is just so telling that the board is so strong in their view that inflation is still the number one thing that is keeping them up at night, and that they are still well and truly at a point where they don't think they could release the handbrake because they are worried what it would do to inflation to the upside if they were to cut rates too early.
Yeah, so let's see if I can bring what those changes were across, and we'll have a little bit of a play around with this in terms of trying to get this on a dual page, but hopefully that's come across. Can we see that on the screen for everyone?
Yep.
Yeah, so we can see inflation was 3.5%, so they've done some adjustments there. Headline declining in July as measured by monthly, so they've obviously just updated those numbers. This has probably been the most significant since then. GDP data for the June quarter has confirmed that growth has been weak. Early declines in real disposable incomes and the ongoing effects of restrictive financial conditions continue to weigh on consumption, particularly discretionary consumption. However, growth in aggregate consumer demand, which includes spending by temporary residents such as students and tourists, remain more resilient. wages pressures have eased somewhat, but labour productivity is still only at 2016 levels.
That's
They are still,
not a good figure.
Yeah, they're persistent on this productivity story. She continues to keep measuring that story there, because obviously higher productivity, greater output means less cost for those inputs, which ultimately again pushes the inflation story lower as part of that story there. What do you make of the next comments that are on there, Evan?
Yeah, so that again will be a big part of the actual overall discussion at the press conference. We know that we have seen some improvements in the data around productivity, but she's right to point that out, that we are going backwards in terms of what is the output for wages, what is the output for per person numbers, and that is something that you and I have spoken about for a while. That it's just not, returning to the numbers that we're hoping. And as you can see, as you scroll down, that last 3 paragraphs now is basically unchanged, and it's all of the same justification that they've been having all year. This is hawkish. It is, again, very much on brand, I think is the way to say it to you as well, Ben, for what the RBA has been all year, which is, you need to understand that we went slow for a reason. We want to bank in what we did during COVID. We're not going to interrupt it, but it also means that we need to put up with, being different to the rest of the world. We didn't go as hard as the rest of the world. And we do have an inflation problem that's being persistently harder to budge than what we have seen elsewhere. The changes in GDP figure are interesting, because I think we'll come back to that, the statement, as we go along. But I think what you and I need to do, Ben, is to jump into the rest of the slideshow, because it will cover off on what we now need to come to, which is the story around GDP, the story around services inflation, and the story that is very much playing into this as well, which is what you want to get into, which is the issues around changes in rent. So let's do this, and it'll answer what we've just seen in that statement.
Yeah, and I think media reports tomorrow, when inflation does show continued improvement, I think she's going to have to stress at today's conference that that's factoring in those cost of living measures that are introduced by the government, which is artificially deflating the inflation story. So I think she's going to have to remind everyone, because the media cycle will be, come on, Governor, why aren't you moving? Inflation's coming down. So I see a lot of pressure up until we get the September quarter inflationary data. It does bounce around in the monthly inflation data that we see, but at the end of the day, they are going to judge it on this annual core inflation. And so we're going to see, they want to be confident that outside of, those energy and sort of very variable sort of moving parts, they want to see that underlying inflation, which is services inflation, is trekking in the right direction. I think we'll continue to see better improvements in goods inflation, but that services inflation has been sticky. And then ultimately, we're going to also have a deep dive in terms of what's happening to property very shortly. And that in itself is, there's some sticky data in there as well. So we can have a look at that particular story.
So just before you go, I think that actually feeds perfectly into, there's a question that's come up. Somebody's asked, should the RBA have gone more aggressive with rate rises back in 22 and 23? So the reason I want to sort of get to that before you come in is the whole consideration around that. The answer to that we'll find out in hindsight, right? So we will find that out very much in the next 5 years. And why I want to start at that point, there is very clear, reasoning that they should have. There's very clear reasoning why they didn't need to. There is also everything in between. And to remind you on that is that with the one thing the RBA couldn't do before COVID was move the dial on what they referred to as full employment. COVID moved the dial by an existential crisis. And finally, they were like, right, we can lock this in and actually help the long-term prosperity of the nation by making sure everybody has a job. But for that, we're going to probably prolong the story. So the answer I can't give you, and I want to say that out very clearly, I can't give you. But what Ben's about to go through is, the machinations and the issues that come with it of being a bit conservative, which has been helpful. It's kept things moving, but it also takes longer because it brings on to the next part. And I want to get you in here, Ben, is, there is another person from YouTube that says rates on hold, good for house prices though, looking forward to rate cuts next year and more house pricing increase. That again, I think also needs to be taken with a pinch of salt, because what you're about to say is what has happened with being conservative has helped, but it does have a hindrance.
Yeah, and I think, coming back to the viewer's question around should they have gone earlier, I mean, we don't have the benefit of hindsight, but they made it really clear under Governor Lowe's leadership that he wanted to maintain as much full employment as possible. There's a couple of things that are outside of his control. One was obviously the resilience of the local economy was supported by population growth.
Yep.
That's one part. And it's also been supported by continued government spending. And, so yes, these reliefs in terms of cost of living reliefs, but they are stimulatory. And so effectively monetary policy is working a little bit against fiscal policy. Now, you won't hear the governor say that because it's politically dangerous for her to commentate. It's poisonous commentary. But that's a reality. I mean, ultimately, we haven't seen the governments being frugal during this time. And if we had have seen them being more frugal, then we would be in a different conversation. We would have seen unemployment increase higher. And remember, most of those jobs are in government jobs, teachers, healthcare, aged care, services is where most of those jobs have come from. So that's why we're seeing a stickier employment story. And that's also why it's another component of why interest rates have stayed higher for longer. Let's now look at this particular chart. Thanks to our good friends at the Housing Industry Association and Tim Reardon there as the chief economist. And so what we can see here is here's your headline inflation in the blue and black, I should say, and then you've got your trim mean, which strips out, that's core inflation. That's another word for core inflation. And then you can see the housing component. Now, the housing component is made of two parts. One is the input cost, or i.e. cost of construction, and the other side of it is actually rents and how quickly rents are increasing. So the government, or the basket of goods does not measure house price movements, in terms of, okay, property prices moving, so that's inflationary. That's not how they do it. They use those two components. Now, traditionally, that makes up about a quarter of the basket of goods in terms of the weightedness towards property. So that's why property is so important. So the governor and the board would love to see some of the trend lines trending in the right direction. And that's what we're going to be talking about in terms of a couple of these charts. We're going to be able to see where we've come from and sort of where we're going. So this is the rent inflation. So what we did see through those 13 rate increases, the typical investor might have experienced an increase in holding costs, especially interest costs, of around $30,000. And they've only really recovered, based on the research we've been doing in the surveys, is they've recovered about 20 or 25% of that. So at the moment, the small business owner is actually subsidising the renter by about 75% of their increased costs. Now, hopefully, as cash rate goes down and those repayments start to get lower and the interest cost becomes lower, that will take the pressure off having to rise or increase rents further. But I can still see above trend increases in rents because of the supply and demand story and the fact that these businesses are still significantly subsidising their renters in most markets. So that's why I still see that this will be sticky, and this number will still probably average, in my mind, over the next 12 months to even 24 months around the 5%, unless we see the cash rate fall considerably. So that's one part of the story. Yes, Evan.
So I'm going to take yours, because there's been another question from the same guy from YouTube. Is stickiness the services inflation specific to an Australian environment and policies, or is it due to external factors outside of Australia? The reason I wanted to jump in there, because what Ben has just given you is the perfect textbook theory of why services are A, the stickiest out there, and B, take the longest to do it. Because normally services are industries that absorb until they can't. And then they will slowly but surely hand that through. So what the argument also is with services inflation, and no, this is not an Australian specific problem, this has been seen across the globe, is that as those interest rates have gone up, as those costs have gone up, this time last year they were like, okay, I can not hit my clients with this. I'm okay. And then they're like, oh, I'm going to have to put a little bit through, and I'm going to have to put a bit more, and it takes that much longer. So there's an argument that we've only probably been at the peak of services inflation for about 6 months ago, rather than the total inflation that was 2022. So this is the difference in why it is sticky, because services are businesses. Services are offerings to B2B or B2C scenarios, and they therefore just take that much longer to filter out before they get back to normality. That's the problem, and we're a service-based economy.
That is beautifully said, Evan. And I think if I can even expand on that in basic economic theory, you've got to remember that demand traditionally is quite elastic. Yeah. In other words, in some industries, it can be quite elastic, right? So, but in housing, supply is inelastic, which means it takes a while for that supply to arrive. So by way of example, if I need to continue to get a haircut, I need to keep going to the dentist, I need to keep getting my regular checkups. That demand elasticity is still, quite consistent. And the supply side, so if all those costs keep coming in, that's the services side. So I can say, look, my energy costs have gone up to run my, salon, all of those other costs. So I'm just going to have to pass on some of those costs, my cost of shampoo and my goods to service you, and all my tinting materials, everything's gone up, so I'll pass it on. But I'm reluctant necessarily to do that, because obviously the competition, or you may not necessarily come back to me, or whatever that may look like. But when everyone's doing it, it makes it a little bit easier for that, and that's that sort of story. But certainly from a property point of view, that whole idea of that elasticity around demand, and so we have been surprised by just how much of demand we're seeing in here. If you had asked me this question 18 months ago, I would have said on the back of those higher interest rates, I wouldn't have necessarily seen that. But this has been a population story off the back of rising rents. So I might as well buy versus rent. And obviously, the immigration story that's also come in supporting that pressure, but the supply is so tight. So you're seeing that supply and demand is out of equilibrium. And so that's pushing prices higher in most states and territories where, that story is consistent with their economic activity. Let's move on now and have a look at the weekly rents and asking rents. So here's where the good news story comes in. What we can see here is when we start to look at the quarter and the annual numbers, when you sum up some of those quarterly numbers, are they going to get up to the same sort of level as the annual numbers? So we would expect that as each one of those quarters starts to cool off a bit, that annual number is going to pull down, and that ultimately quarterly number that we saw in the last chart will start to ease back towards that sort of level. But I still think, again, with that imbalance between demand and supply, that rents are probably still going to be quite sticky, and they are going to contribute to higher inflation for longer until we deliver that supply in the market that's desperately needed. But we can't do that because we've also got APRA putting throttles on lending and higher interest rates. So that's an important point to make there. I'll just move on to the next one before I let Evan sort of also add some further value to this. This is a very fascinating chart, and it brings home. So this is the average value of a detached home approved in Australia. So what we're seeing here, and what we saw in the report, that the average value of a detached approved home nationally in the June quarter increased by only 0.2% compared to the March quarter. And that's shown that, so to build this home, it's 472,800 when we take that aggregate in around the country. Now this is 3.1% higher compared to the same quarter in the previous year. But here is the rub. It's 42% higher to build the same property than what we could build pre-COVID. So this is this story. So what we've seen, we saw obviously the supply chain bank up, and we saw still huge demand off the back of the home builder incentives that we saw from the previous government to get us going out of COVID. And so prices went up for everything, timber, plumbing materials, everything went up sky high because you could get access to it. And then wages also followed in on that off the back of obviously the infrastructure programs, the record spending on infrastructure. So getting access to that labour in the sort of residential building versus going on to building a tunnel for a new train line going through a metro rail and so forth. All of that has contributed to where we sit today. Now, that's extraordinary in terms of 42% higher in 5 years. And to that point, it's very difficult to sort of pull those numbers back. But we are starting to see that when we look at the material price changes. So we can see here those changes of those materials are hopefully cooling off even further, but it's still pretty consistent, because the problem with it here is the demand's still quite strong, and people want to get on with their lives, and they're continuing to build. So it's lightly sort of delicately poised in terms of what that story looks like.
Yeah. So just before we move on there is a question that's come from a statement that you made probably about 5-10 minutes ago, Ben, about tenants and how they're dealing with the costs of it. Do you want to run through? So the question is it correct logic to assume that tenants to pay the landlord's mortgage repayments 100%? Followed on, same person, they say that landlords are subsidising the mortgage repayments and not charging tenants the full amount. Do you want to take through that?
Well, I think what's happening here is we've got to remember a couple of quick things, right? Firstly, that the landlord, i.e. the mum, the dad, the couple, whatever they are, the individual, are going into an investment business, and that business is providing private rental accommodation. And if I can get a risk-adjusted return or a risk-free return at, say, 5% by putting my money into Australian bonds, or 4.5%, and so it's government guaranteed, I need to get a better return on my money to invest it into property. And if I don't get that investment, then ultimately I won't invest in property. And that will mean people might say that's a good thing, because it just means that more people will be able to buy property because there's less competition and prices won't grow. But what you've also got to understand is what happens if you want to grow the immigration story and you want to take the nation forward in terms of building out greater consumption and GDP, which increases overall living standards, increases wages, et cetera, et cetera. So when you are talking about that broader economic flywheel, you need to have that available accommodation, because a business or a project might want to start in a town or a city, and it's a large infrastructure project. Well, where are you going to get those workers from? And some of those workers are only going to be temporary because of the construction phase as opposed to the ongoing phase. So that's why it is important that we have at least 20 or 25% of our properties available for that rent. So there's also people who want to move out of home for the first time and experience, living with flatmates or mates and those type of. Now, so that's the bulk of the people who take up rental accommodation. There is obviously the most vulnerable members of our community who take up accommodation, and they're the ones we need to look after. And so they're the ones we need to have public and social housing for. But on the whole, your economy needs to have that private rental accommodation. It's how cities originally started. It's how towns turned into cities, is ultimately people that were arriving because there was jobs and they needed somewhere to stay, straight from the story of Christianity in terms of, having to be born in a stable as opposed because there was no accommodation available there at that time. So I think it really is important that we remind people of those types of things. So what the investor needs is an adequate return for the risk that they're taking. And so that return usually sits in that sort of 8 to around 10% overall return. So if they're getting that, they'll continue to keep investing. If they're not getting that, and if all of the income that they're generating off their investments is going towards paying taxes or insurances or whatever, and they're not getting that return, they just won't invest in that. And that will be a significant sort of drag on economic activity for our economy over the medium to longer term.
I'm going to actually keep going with your story, because there's a couple of questions I think we want to do at the end. So sure. Let's finish up with your housing story, because I think it's fantastic.
Well, I think that wraps up the sort of housing story, right? Like, so there's enough evidence in there to suggest that, especially with the less students coming in for international students, that'll take a little bit of pressure off vacancy rates in our bigger cities, and that might take a little bit of pressure off rental growth. But we've just got to basically see getting rid of the red tape and getting rid of all of the challenges around planning regulations and so forth to be able to, get ready for build. And I think, necessity is the mother of invention. So I do feel like, those costs in terms of labor costs and in terms of how we manufacture and how we build, I suspect, prefabbed homes, modified homes, 3D printed homes, all of these things will be part of the solution over the next 10 or 20 years in terms of, because those costs are so high. But I don't think we want to be playing so much with land values because, that underpins the reason why you might take out a mortgage as an owner-occupier and take out a $500,000 mortgage because you're hoping in 30 years' time that your land's doubled in value, so you just haven't been paying really to rent a place because you haven't made any value out of that. So I think that's probably enough for today in terms of that story. I'll just hand over to you now to sort of just talk to this pattern that we're seeing in terms of the annual GDP, and then we'll close out today in the next 5 or 10 minutes, Evan.
Yeah. So we keep hearing about, GDP growth, and I need to highlight that growth is declining. And this chart tells you that. That's exactly what this is showing, is that quarter on quarter, we are now getting back to some pretty anemic numbers, and it hurts. It means the consumer is under real pressure because consumption makes up about 60 to 65% of Australia's GDP. What it doesn't necessarily show, and what the governor at the moment is really strong on in her view, is the amount of value going through in GDP is actually still significantly above trend. And because we have a high level of demand still in that level that is above the amount of goods and services that we're supplying, it means that, yes, growth is slowing and GDP, gross domestic product growth, is slowing, but the total volume is actually, or the total value is still elevated for what we're doing, and that's keeping inflation up. So that's the line that she keeps highlighting. I don't think she does it brilliantly because I think it gets lost in the ether. But that is the other thing about what we've just seen in the statement. So that's why I wanted to leave this in, because I know we're getting tight for time. Yes, growth is slowing, but the value of GDP out of Australia is still above trend from the 2019 level, and explains why we still have inflation at the level that we currently have.
And Evan, just to give some context around that, the average annual growth rate in Australia from 1960 to 2024 has been 3.35.
Yeah.
Now, the challenge with that is compounding returns get harder and harder. And that's, to your point, a 1% movement in GDP over a year is still a material value number because the economy is, I don't know, what is it, 30 times bigger, 40 times bigger than what it was in 1960. But that's the context in terms of, so it is going to be harder. And if you look at the, those long-term projections that we see coming out of government sort of forecasting, is they are expecting that the sort of long-term, that they need to sort of keep it moving at around 2 to 2.5%. If they don't, then that's when we are going to be putting pressure on standards of living, because we may not have enough jobs to go around. And obviously those jobs create the taxes that pay for the schools, that pay for the hospital and medical services, all of those sort of essential services that we're so blessed with in this country come off the back of economic activity and, collecting those taxes. So what we don't want to do is slow that economic flywheel and take more of our citizens' taxes to basically pay for that. So you don't want a situation where you've got a really high taxing society and you're not necessarily getting that benefit. What you want to do is continue to keep growing the economic pie and then basically let everyone contribute to that. And you have more net contributors than what you do in terms of net takers. Does bode for a really good sustainable story and continued improvement living standards for all and in this country. Let's have a look now. This is the last thing we want to be focusing in on, which is the unemployment story. So you'll see that obviously we had an interesting result out of the unemployment story. Most economists forecast that the unemployment story would deteriorate a little bit further in the recent data. So let's just go through that. The unemployment rate came in at 4.2, which was unchanged from the 2.5. Unchanged from July 2.5 year high, right? So ultimately, it's basically saying that we've got this unemployment story that's better than expected. The numbers of unemployed individuals dropped by 10,500 to 627,000. For those looking for full-time work, shrinking by 7,400 to 421,900. So there's 429,000 Australians basically looking for full-time work at the moment. Now, those looking for part-time work declined by 3,200 to a reading of 205,000. So they're trying to get work-life balance, maybe raising a family and just looking for that part-time work. So the August employment increased by 47,500 jobs to 14.46 million. Now that easily surpassed the consensus of 25,000 new jobs. It was double or thereabouts in terms of that. Now that was also downwardly revised from a 48,900 in July. So we did see that number come off in July. Now this was off the back of a surge in part-time employment. So we saw 50,600 new part-time jobs come into play, and we lost 3,100 full-time jobs. So if you think about this blunt instrument that is interest rates, losing those full-time jobs, picking up part-time jobs, that's also sending a signal out there that businesses are sort of a little bit more apprehensive about forward-looking and locking people into full-time employment and just taking people on potentially on a casual or part-time basis as part of that. Now, our participation rate, to Evan's point earlier about the US only at 62, we're at 67.1. The underemployment rate rose to 6.5% from 6.3% in July. And additionally, this is probably a good news story to finish off on a positive. The monthly hours worked in all jobs increased by 8 million or 0.4% to 1.962 million, which obviously helps with the right direction of increasing that productivity. So remember what the governor said in her statement. We still haven't got productivity back above, I think it was the 2016 level. So we've got to do something about that particular story.
Yep, we do indeed. And look, before we go, thank you very much for all of you tuning in. If you can, please give us a like or what have you on the channels that you're looking at. And if you haven't already, please subscribe to the channels that you're coming through on, because we need to sort of want to keep doing this and make sure you're informed. So we'll just finish off with the last two slides that I know Ben's got. I know we haven't also got to all of your questions. Please, however, keep sending them in. We will get them back and answer to you as soon as we can.
Yeah, so we did see obviously off the back of, the consumer confidence story, and we saw, those, the stubborn inflation. It's really has meant that consumers are, more worried generally, and the only positive in this story is that they feel pretty okay about their jobs. So that's probably been the only positive in the sentiment story, but we can see it is trending up, but it's very stagnant. And the long-term reading of that, when we look at over that very long period of time before COVID, we are usually around that sort of 100 mark. So, that's the optimism versus pessimism in terms of that reading. So we didn't see anything there. In terms of the final summary was that obviously the cash rate is on hold at 4.35. And then I just wanted to get your final opinion, Evan, in regards to where you see this is the 30-day intraday bank cash rate futures in terms of where we see the cash rate moving to.
Yeah, so this, I think, is the way to finish it. And to finish what we've done today, we've just spoken quite strongly about the fact that the RBA has made it clear they're not going to cut rates in 2024. And I know one of you sort of quite cheekily put in there, and very nicely so, that, it'd be nice to get a 0.25 of a cut before Christmas. But this is what the market is still forecasting for the next year. I want you to have a look at the August figure, because what August is telling you is that it is pretty much forecasting in the idea that we will have 3 rate cuts with the fairly high possibility of 4, because that's forecasting a full 1% out of the cash rate at the August number. You then go through to December, and by the end of next year, they are suggesting, this is the market anyway, that there will be a further 5th rate cut coming next year, taking the cash rate to 3.1%. Now, so it's not fully priced in, but whatever way you look at it, there will be cuts next year. That is clear from what you can hear in the data, what you're hearing, even with the really strong views by the RBA right now, that GDP is weak. Yep, unemployment's starting to tick up, but the inflation story is still a problem. They will release the brake before it gets there. I think that also needs to be put out there very clearly, is they are looking at retrospective data. We are basing all of this comment on what happened in June. We don't get the next real update about the quarter that we're in, being the September quarter, until the last couple of weeks of October with inflation and GDP. That's why November, if it was to happen this year, is the only month that would matter. It's probably not going to happen. But what we need to remember is that despite the strength of the statement, despite the views that inflation is there, 2025 will be different to how this year is. And it may be a bit like the Fed that we sort of get, when Fed started and they're away. It probably might be the same, but it will happen.
Yeah, and so let's think about those takeaways. We still think that unemployment is, playing on the minds of the RBA and the board in terms of, and does that give business confidence to keep passing on prices and keep pushing interest rates higher? In terms of we are going to see a continued sluggish economy, and that's by design in terms of what that looks like. The housing inflation story is hopefully heading in the right direction, which will take a little bit of pressure off, but you can still see it's clearly higher above, and that's part of that services sticky inflation that we talked about there as well. In terms of the other big news story that I wanted to make sure we all understand is over the course of the next couple of weeks, we get a hell of a lot of good data, including inflation data that's coming out tomorrow, and a lot of that sort of outlook in terms of monetary policy and in the monetary statement as well. So there's a lot of data that we're going to digest, including some of that new jobs data as well. So there really, says to me that the chance of a rate cut this side of Christmas is getting lower and lower. We still have one current Big Four bank in CBA predicting a potential rate cut, a Christmas rate cut in December. The other three have moved their prediction into the new year, some earlier, some sort of as conservatives as sort of May next year as well. So it's just going to be an interesting time in terms of how strong the economy is, and we're trying to put the brakes on the economy to get this inflation story down, aren't we, Evan?
We are indeed. And so we'll finish on that. Just also remember, the machinations of next year. We do have a federal election, and we have we only have 2 meetings before the next one. And so we've got February, then March, then the election will happen. So the third meeting for the year will be after that election. And so, look, thank you so much for today. Please have a good read through of the disclaimer. I know we didn't get through all of your questions, but we want to try and keep these to about an hour. It's been a pleasure to do these lives, and Ben and I are looking forward to now doing this as our ongoing thing. So from my end, thank you as always to watch. And Ben, I'll let you have the final word as always.
Thank you. I just wanted to say, please give us some feedback. Is this sort of format something you're really enjoying, you're liking? If you are watching it on demand later on, again, is this sort of new format, this more interactive approach, and this sort of live feedback type approach, something you want us to keep doing? Because we'll continue to keep looking at that. We do have the November, which is the Melbourne Cup Day. We may revert back to the previous way we're doing it, but certainly our December update will be a live update. We're still trying to work out logistics for our staff in terms of, and the great people behind the scenes that help produce the show for the Melbourne Cup public holiday. So we'll probably go back to the old format, but then move towards that new format if that's what our community wants us to do. So thank you again for watching. Make sure again you look at the disclaimer and make sure you understand that you should be able to seeking professional advice, and you shouldn't take this as any type of investment advice in any decisions that you're making. But thank you very much. And until next time, remember, knowledge is empowering, but only if you act on it. Bye for now.